Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We are pleased to welcome today Charles Nadim, Co-Head of Equities and Portfolio Manager for Canadian Equities, here to talk to us about the Jarislowsky Canadian Equity Strategy and their market outlook. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Charles, the floor is yours.
Thank you, Matthew, and good afternoon to everyone. So if we move on to the page one of the presentation, before I get into portfolio positioning and performance review, I do want to spend 10 minutes with you discussing what I think is an increasingly undervalued, attractive opportunity over the next 5 to 10 years. And that is really looking at this investments through the lens of our investment criteria. If you look at page one of the four key criteria we look at is a company that has a secular growth potential in industries that are non-cyclical, where we have high visibility in earnings and cash flow. So this particular company has one of the most attractive secular growth potential over the next 5 to 10 years. It also has an extremely strong balance sheet. It has superior corporate governance and attractive valuation. Actually, every investor, 9 out of 10 investors I talk to are actually reducing their exposure to this investment, while we think it should be the opposite. And that company slash country is actually Canada. So if you look at this page two, moving on to page two and really focusing in on the first key element. If you have a long-term view like we do, you know, our turnover is 10%, so we hold investments for 10 years. One of the drivers of growth is innovation. And having page two shows that among the OECD countries, which are 36 developed countries, the fastest growing country among those from a population standpoint is actually Canada. 2/3 of the growth, 1.2%, comes from migration. The rest is being natural. So we have a strong foundation that supports growth, and that's pretty well known. If you look at, if you put that in absolute numbers on page three, one would argue, okay, yeah, we're 1.2% is the fastest growing, but it's off a smaller base than the Americans, for example. So it puts us fourth on an absolute terms in terms of immigration inflows, around 250 to 300,000 per year, which is still a respectable number. But what is misunderstood or undervalued within Canada, which gets us excited in terms of investment opportunities, is the next slide. On page four, it shows that Canada is extremely picky when it comes to its immigration policy. The right word, they call it the economic category. It's basically how admissible are these permanent residents as a contribution to the economy and integration into the workforce. 64% of our immigration fits that category. You can call it talent or higher education, whereas it's only, as an example, 15% for our neighbors in the U.S. Now, if you overlay that percentage versus the absolute number of immigrants coming into the country, you go on to page five, and it shows that actually Canada is attracting the most talent globally. And it's been the case now for a few years. And I think that bodes well for the future opportunity of innovation. And you're already starting to see it. I mean, just a data point for you is if you look at artificial intelligence, which is kind of the next generation of technology, potentially disruptive technology, the biggest concentration, the highest concentration of startups in artificial intelligence in the world is actually in Toronto. So that's kind of an interesting data point. Now, this is all about immigration, but if you look at population, the actual population on page 6, Canada has the most educated population in the world. If you look at the share of population between 25 and 34, but there are many stats on that. With post-secondary education, Canada ranks extremely well. So not only we have an existing base that's very highly educated, we are attracting the most talent, and it is increasingly visible. It's actually one of the reasons why we launched a small mid-cap fund 2 years ago, because we started to find increasing opportunities in that small mid-cap space where you tend to see this innovation play out. Now, on page 7, it's no surprise. Why would you start a business or move your family to Canada? I mean, it is the second best country to live in, ranked now 3 years in a row. And that's based on attributes such as quality of life, human rights, gender equality, education, economic influence, healthcare, and public safety. So Canada ranks extremely well. And if you just focus on this first criteria, which is sustainability of growth over the next mid to long term, our odds of generating, sustainable growth is quite high. Now, in a perfect world, you'd have the opportunity to grow, but the balance sheet to support that growth. And that's the case for Canada. If you look at page 9, it shows that Canada has the most flexibility in its balance sheet. Its net debt as a percentage of GDP is the lowest amongst the developed countries, around 25%. And that's important because, when you think about resilience of a company, the ability to offset any potential recession, to invest in innovation, to invest in infrastructure, Canada has that potential. And one of the things I hear often as well, our tax rate is high, not our corporate tax rate, but our personal tax rate. But we have the firepower, and we'll see what management does in terms of the leadership. But we have optionality that many others don't. In addition to that, on page 10, you see that fiscally, we manage our books quite well, other than Germany, which is even more conservative than we are. Our deficit as a percentage of GDP is quite small at less than 1%. So, and the last thing I'll say on the balance sheet side is on page 11. The foundation of an economy is its banking sector. There's a reason why Canada came out pretty, immune for the financial crisis. We have been year after year ranked number 1 globally in terms of the soundness of our banking sector. So we have a sound banking sector, a very strong balance sheet. It's a well-managed country when it comes to the budget deficit. So we have all the key ingredients to invest in the talent and the existing population. Now, as an investor, we have corporate governance very high on our priority list, and it's integrated into our philosophy and our process. And if you look at Canada and the perspective on economic freedom and things like rule of law, openness of market, and regulatory efficiency, Canada ranks very high, number 6 globally. And on page 14, we put in on the left side some governance KPIs that come from Sustainalytics. Things we look at: percentage of women on board, diversity, percentage of independent directors, and Canada ranks above the average in all of them. And on the right side, where lower is better, and things like CEO duality or ISS risk score, Canada ranks well there as well. So from a governance standpoint, I mean, we are already much better than many other developed countries, and I would say that we also are improving at the fastest pace, or we continue to improve on the governance side. On the valuation slide on page 16, I mean, I could show you 20 slides on this that make the case for Canada. I think the way we look at it is we look at our Canadian equity portfolio and we say, what kind of expected return should we expect from our portfolio over the next, 3, 5, 7 years? And it is at these levels, we are still in that kind of teens level, 12 to 15%, including the dividend yield. So despite the run we've seen in the market this year, it's the strongest start of the Canadian market in close to 100 years. We still see tremendous opportunities in Canada. Now, it's not that there are no risks out there. On page 18, there are 2 key risks I hear about often. One is the housing market and the housing bubble. And it's true that if you look at just Canada and versus history, housing has gone up quite a bit and could be a sign, something of at least to watch closely. But this chart on page 18 shows you that if you look at Canada actually from a global standpoint and being the second most attractive country to live in the world, even a city like Vancouver, which has gone up tremendously, ranks below every other major city globally. In Toronto, it's even better, and obviously Montreal and going down. So this just gives a global perspective of what is the price per square foot in USD for downtown living. And not to say, again, that, we're going to keep going up at 10% a year, just to say that for somebody looking where to start a business globally or where to move your family globally and looking at the options out there, Canada, even Vancouver, still ranks okay. And the last thing I'll say is on the leverage side, yes, consumer leverage has increased, a reflection of the interest rates. But the only thing I would say, I mean, all the economies, developed economies, have seen their consumer leverage go up. The only thing I think about is, should we look at this from an apples to apples, as in all populations across the world should have comparable leverage, or should we think about it as the level of education plays into the sustainable level of a consumer debt? So I would argue that Canada, despite having, for example, slightly higher consumer leverage than the U.S., it is explained by the level of education of its population. Now, on page 19, before you call me, biased or crazy, actually, if you look at in the past 10 years, Canada's economy has been outperforming every other economy out there. It is the top performing economy. Now, why is it that we have the top performing economy and we've lagged in terms of the performance of the index versus some of our developed peers, especially in the U.S.? So if you look at the long term, we've generated returns of 10 to 12%. Returns in the U.S. have been higher than that. And obviously, the Canadian index is not as efficient as the U.S. one. It's much easier to beat. Our value add over the long term has been 200 basis points. But despite that, the market has lagged the U.S. performance. And I think I can explain it by page 21. If this page 21 shows you two pie charts. The left one is our actual portfolio, the Jarislowsky Fraser Canadian equity portfolio, and the composition of that portfolio looking back at 2007. And if you look at the portfolio, you'll notice that 31% of the portfolio was made out of commodities, energy, mostly energy companies or some materials. That fit our philosophy. Global leaders were only 11%, and the rest were regional leaders. So a difference between a global leader and a regional leader, Metro, which you know well here in Quebec, the grocery store. I mean, that's mostly a Canadian company, Quebec and Ontario. That's a regional leader. A global leader would be like a CGI, one of the top two global consulting firms in the world. Now, this portfolio back in 2007 is a reflection really of what was available to invest in Canada. If you fast forward this to 2019 in January, and you look at the composition of our portfolio, only 6% of our portfolio today is actually commodities. Global leaders has now reached 44% of the portfolio from a weight standpoint, and regional leaders is 50%. So a lot of these regional leaders have become global leaders. But the message here is that, commodities, they're cyclical. They go up, they go down. It's a question of, timing them. But over the long term, they haven't generated much return on an absolute basis. And that's been the drag to Canada from an index standpoint. If you exclude that and you look forward over the next 5 to 10 years, we actually argue that Canada will be one of the best, if not the best performing market in the world. Now, on page 22, it's very important to make the point that you cannot just focus on large cap in Canada. This S&P TSX index has only 246 companies, whereas in Canada, you can actually invest in 760 companies. And even if you look at the small cap index, which is an extremely inefficient index, of which 50% is materials and energy, there's only 205 companies in there, of which 23% overlap with the large cap. So in that new small to mid cap fund we started, we look at the 450 companies between 100 million and 5 billion and pick the 25 best. What I'm trying to say is there's a lot of good companies in that dark blue area that you have to keep an eye on, because that's where a lot of the innovation is starting to show up, and where the talents, the startup you're starting to see. So that's an important point to make. I'll actually skip to now page 25 and talk a bit about how we build our portfolio before getting into the performance side. I spoke about the emphasis we put on industries with secular growth trends, industries with high barriers to entry, which leads to superior return on invested capital. We focus on global and regional leaders. The 4 criteria are competitive advantage, quality of management, corporate governance, financial strength. We want companies that have a strong balance sheet that can invest and acquire other companies, take advantage of volatility in the market, and we focus on valuation. Valuation, we keep a long-term view, 5 to 7 years, and we think absolute. So for non-cyclical businesses, we kind of look for 10% return, and for the more cyclical business, 15%. ESG is integrated into our philosophy. We are actually the co-founders in Canada of the Canadian Coalition of Good Corporate Governance in 2003. It has over $3 trillion behind it, and it is, it's integral into our research process. And we have something called the Investment Strategy Committee, which ensures that there's adherence to the firm's long-standing investment philosophy. All that leads to a portfolio of a highly concentrated portfolio. If we look at the portfolio today, we have around 30 names, and turnover, as I said, out of the gate, has averaged between 8 and 10%. So we keep names on average 10 years plus. Now, I'm going to show you charts that show that over a long period of time, we've added very good value, but also maintained a very low level of risk. And that's a reflection of page 26. If you look at our portfolio and you group it and you cut it in 3 groups, Group 1, which is 70% of the portfolio, would be those non-cyclical stocks that are, we have higher visibility in earnings and cash flow. They tend to be less volatile. For those stocks, we look for a 10% expected return, including the yield over the next 5 to 7 years. So it's basically a double in 7 years. For the Group 2s, which make up 24%, those we want 15% return given the slightly higher risk profile. An example of a Group 2 stocks, which are more economically sensitive, would be like an engineering company, an energy company, a materials company. We also have a small allocation to Group 3, which are small to mid caps, mostly mid caps. And that's a special equity fund which we have that is an incubator for these long-term Canadian champions. So the message here is we have a very high bias towards non-cyclical businesses that operate in an industry with visible, strong secular growth drivers. And in a perfect world, these industries are fragmented, which means that our companies that have very strong balance sheet and generate good cash can take advantage of volatility to continue to consolidate the market. And that has led to us to outperform in down markets. And if you look at page 27, 27 is looking back 26 years and showing exactly the performance of our fund in 26 years of performance years. And there's a strong consistency here. If you look at the first line, the green line, which is the value added in down markets. So every time the index in Canada has been down over the last 26 years, there's been no exception. We've added good value. And that's a reflection of what I said, the composition of the portfolio, the heavy bias towards the non-cyclical businesses, and the strong balance sheet. So very good value add. 2018 was actually a very good year for us. We ranked first quartile there, and we were able to protect on the downside with 2.6% value add. Now, if you look at the last line at the bottom, the blue line that shows the cyclical market performance, we've been pretty consistent there too. When you have a very cyclical market that's led by the materials, the very cyclical businesses, we tend to underperform. Actually, if you look at it over the last 26 years and you look at the something called the upside capture and downside capture, we capture around 92% of up markets, but we protect 50% in down markets, which leads to a 200 basis points value add. Now, if you exclude the down markets, the green line, and the bottom one, the cyclical markets, what's left in the middle is every other market, the mid-cycle markets, call it that. And in those markets, 90% of the time, we tend to outperform. So the message here is when you buy Jarislowsky, because of the philosophy, because of the process, because of the team, the way we do things in a team approach, there's been a very consistent profile in terms of returns. Page 28 shows you that kind of profile over a long period of time from a risk-return standpoint. So we are the kind of blue square in that chart. What you want to be, the bottom line is the volatility, and the return is on the left axis. And obviously, you want to be the top return at the lowest risk. You want to be in that upper left quadrant, and that's where we are. And it shows the kind of value add versus the TSX, which is the red dot. So that's been consistent no matter what period you take. I show you 5 years here, but 5, 7, 10, 20 has been quite consistent. On page 29, we show you what today is our top positions in the portfolio. There's one thing I'll say off the start is that it's kind of interesting. In line with my global leader comments below, we run today a 30-name portfolio. And if you look at the top 10, 9 of the 10 are now global leaders. Global leaders, it's either top 1, 2, 3, but they're definitely in the top 10. So OpenText, for example, is a software company that's the #1 in the world for enterprise content management. Those are software solutions that help companies manage information, which is exploding. Data is exploding because of either internally within companies or for compliance reasons, the communication between customers and the company, suppliers and the company. Companies have to maintain information, be able to retrieve it, classify it, and OpenText is the global leader. Now, one would say, well, okay, how come your biggest overweight, which has been the case for a long time now, is a technology company? Isn't that higher risk? Well, actually, if you look at all the technology companies we own, they all fit in one category. It's software and services only. These are businesses that are highly recurring. In the case of OpenText, 75% of the revenues come every year. 75% is recurring at over 75% gross margins. Highly recurring, highly cash generative, and it's been using that cash to consolidate the industry, and it got them to today being number one globally. I don't think you need that. You all know what Alimentation Couche-Tard is. That's another one of those companies that has gone from being a Canadian company to a U.S. company to now the number two globally behind 7-Eleven. And what we like about Couche-Tard is the fact that it's still a very fragmented market globally, but also there's an organic growth element that's misunderstood by the market. Couche-Tard is significantly improving its offering within the store, which is leading an acceleration of same-store sales growth. And even in markets where, one of the concerns we hear about Couche-Tard is what about the electric car? How's that going to impact Alimentation Couche-Tard? Well, actually, the country that has the highest penetration of electric cars is Norway. It's 7% of the fleet. 1 out of 3 new cars sold in Norway is electric. The next country below that is 1% of the fleet. So significantly ahead because they have tax discounts in Norway. You don't pay VAT tax when you buy an electric car. And if you look at who's the biggest chain of gas stations in Norway, it's actually Alimentation Couche-Tard. So that's a good test bed. And if you look at Norway, Alimentation Couche-Tard has actually been growing earnings at a clip of 5-6%. So how do you explain that? Well, what's happening is they've installed superchargers that allow you to charge 80% of your car within 8 minutes, where typically it takes you 5 minutes to fill your car with gas. In those 8 minutes, you go to the store and you eat healthier foods, and that's leading higher sales in terms of within the store. So that, I think, is going to be something that's going to surprise the market over time as electric cars continue to grow. But you go down the list and being Gildan and the Basicware, CGI, one of the top 2 global leaders in IT services, Thomson in legal databases, CCL Industries. CCL Industries is the global leader in labels, but not basic labels, advanced, high intellectual property labels, around 30% market share. The second player would be less than 10%. It's a global leader by far. Saputo, which 15 years ago wouldn't even make it to the top 20 in the dairy processor, today is number 8 globally, but still has tremendous potential for growth, not only organically, but consolidation. Like they're number 1 in Canada, number 3 in the US, but only 10% market share. They're now number 1 in Australia. They weren't even in Australia in 2011. There's rumors they're looking at New Zealand. They're not in Europe. They're not in Brazil. So there's still tremendous opportunities for consolidation. Restaurant Brands is the position we like. It's the owner of Tim Hortons. We used to be the biggest shareholder of Tim Hortons, and we like that business of franchisees, very light on capital, very recurring business, high cash flow generation. The only name in this list that's a regional leader and not a global leader is Canadian National Railway. And some businesses are just regional. Railroad is an example. There's no global railroad, but Canadian National Railway is the best railroad in the world. Same could be said about our banks, which are regional, our pipelines, our grocers, and so on. And finally, Manulife, which is, gives us exposure to Asia, growing wealth and insurance penetration. So that's a snapshot. If you look at our active weights, they vary typically between 100 and 300 basis points. We have more between 2 and 300, and the overweight is a reflection of our history with the firm, the valuation, the catalyst, the cyclicality of the business. And if we focus in on page 30 of the drivers of performance for 2018, it's not going to be anything that surprises you. A lot of these names actually have been, Thomson is a very defensive business. We didn't own Suncor, which contributed. CGI, which continues to see acceleration and growth inorganically, and then some energy companies that we didn't own. But if, in addition to those lists, you will see names like Metro, for example, which was a strong contributor in terms of performance. On the negative side, despite being underweight in energy, I have to say, we have 5% in exploration production, but they did not do well in 2015, mostly because of that heavy discount that ballooned because of the pipeline constraints we had. And we think it's at this point in time, they do provide some good value, risk return, but I do see the day where that 5% in energy goes even lower just because of the reflection of what's available out there in Canada. Manulife, Industrial, Alliance were also stocks that kind of lagged. Part of it was interest rates, part of it was the markets that were down in Q4. But we added to some of these positions, and our outlook is actually quite positive. And I'll close off by showing you on page 31 the positioning of the portfolio. We build portfolios bottom up. This is a reflection of the bottom up selection. We don't buy anything because if it's in the index, but if we do buy it, we want to be between 100 and 300 basis points overweight. And when you put it all together, that's the picture. Financials, we have a higher overweight in the insurance stock and Intact. Industrial, we're very positive on the engineering companies, CAE. In energy, it's mostly pipelines that we own. Consumer staples, it's the metros of this world, Alimentation Couche-Tard, IT, CGI, OpenText, highly recurring, high growth, organic growth businesses. In the discretionary side, it would be like a Gildan, which is the basic apparel, white T-shirts, underweights, things that are non-cyclical, and restaurant brands, which is food, convenience stores. And materials, it shows at 7.5%, but actually the names we own there would be like CCL, which is labels. It's not really materials, but it's classified as a material. And the other one would be Nutrien, which is the global leader in agricultural nutrients, which is the old potash combined with my God, I have a blank here. Sorry about that. I have a blank on the name. Agrium, potash and agrium that combine to become Nutrien. So that is the snapshot. We're very happy with what we own. 13 to 15% expected return over the long term. Canada is evolved. I don't think the market has caught on yet. I think it's going to lead to better performance in the next 5 to 10 years versus historical, which has been decent with 10 to 12%. And I will leave it there. Some questions if there are any.
All right. Thank you, Charles. So now proceed to the Q&A part of the webinar. So first question we have, how do you control the level of risk in the portfolio?
Yeah, I mean, so I think the first thing worth mentioning on risk and the reason why you see us, no matter what period you look at, 3, 5, 7, 10, 25 years, we rank at the bottom quartile when it comes to risk, is the process and the philosophy. We've designed a model where we make sure, it starts with people doing research. And if you have 3 to 4 experts that have 15 to 20 years experience in an industry and you put them around the table to come to an investment conclusion, the odds of making mistakes are much lower than if we had one specialist by sector. So not only we have multiple industry experts, they all take a global view to Canada. So we've been very fortunate because we've been able to compare, situation in Canada to what we've seen globally, and it has helped us make less mistakes and generate better returns. So the first element is the people and the way the team is designed to minimize risk. Then it's the businesses we buy. Those businesses that are non-cyclical, high barriers to entry, those by definition have higher visibility in earnings and cash flows, and then hence will be less cyclical. Then you have the balance sheet. Stronger balance sheet means lower risk, means lower volatility. And finally, the investment strategy committee. So there's a consistency to the style. It's not a one-man show. There's 8 people on the investment strategy committee that make sure that the style and the philosophy is consistent across time. You put that all together, and that is the recipe for the lower level of risk.
Okay, thank you, Charles. Second question, what are the implications of a more global portfolio during a recession?
So this is interesting. So by having 50% or so of our names being global leaders versus 11% 10 years ago, think about it. If you're in a business that's non-cyclical, that generates good cash, and you're only a Canadian company, and you hit a downturn, well, the optionality to deploy that capital is there, but it's limited to Canada. So you can only consolidate Canada. But if you're a global leader and you have the same business, the same cyclicality, the same cash flow generation, your opportunity to deploy that cash is significantly higher. And if you look at the businesses, those top 9 out of 10, I showed you the top 10 overweights, the 9 out of 10 global leaders, look at how they've performed in the last downturn or how they perform in down markets that we see from time to time. They significantly outperform. And it's just the reflection of the businesses they're in, the cyclicality, but also they continuously use that balance sheet to consolidate the market. Like Saputo is an example. When we hit a downturn in dairy, they went from not being in Australia. They bought their first asset in 2012, and last year they bought the number 4, now they're number 1. They use the balance sheet and the volatility of the dairy market to get to that position and to now be number 8 globally versus not even top 20. So by having a more global portfolio, I would think that in the future, we've already defended you on the downside. You look back to 26 years, but there's no reason for that not to continue or to even get better in future recessions.
Okay, great. Well, thank you very much, Charles. The presentation was really interesting. We don't have any other questions at this time, so this would conclude the presentation. So to all of you who have listened to the webinar, thank you for your participation. Have a good day.
Thank you very much.